The truth about the January 31st, 2026 silver crash is going to shock you. Why? Because the real carnage, the real bloodbath, started a full 3 hours before any mainstream news outlet even knew what was happening. We all saw the headlines. Silver plummeted from a bubbly $121 an ounce to below $75. In a single day, $4 billion in investor accounts just vanished. Poof. Gone. But here's the part nobody is talking about, the part that changes everything. The market was already down a staggering 27% before that first Fed chair headline even hit Twitter. So if it wasn't the news, what yanked the rug from under the market? What caused this historic flash crash? It was a perfect storm, a three-part cascade that happened almost entirely behind the scenes. First, while everyone was sleeping, the CME, the exchange that controls futures trading, quietly hiked silver margin requirements by 25%. Think of it like a bank suddenly demanding a much larger down payment on your mortgage, effective immediately. This forced over-leveraged hedge funds to puke their positions, to sell at any price the second the market opened. Second, at the same time, the crypto market started to tank. Bitcoin dropped $3,000 in just a few minutes. Now you might be asking, what does Bitcoin have to do with silver? Well, many big hedge funds use something called portfolio margin. It means their crypto and their commodities are all in one big pot. So when they got a margin call on their crypto losses, they had to sell whatever was liquid to raise cash. And that day, silver was on the chopping block. The crypto margin call triggered a massive silver fire sale. Third, the algorithms took over. Once the price sliced through the psychological $100 level, the trading bots, the algos, saw a broken trend line and automatically started selling. Then, as the price fell further and broke through $90, even more bots piled on, accelerating the crash. It was a self-feeding waterfall of selling. And here is the most insane part. While all these paper contracts were being dumped and cascading downward, physical silver was nowhere to be found. China had completely blocked exports. Buyers in Shanghai were paying a $30 premium above the spot price just to get their hands on actual metal. The COMEX vaults, they were basically down to fumes. So the crash you saw on your chart, that dramatic nosedive, was about 79% mechanical and technical, not fundamental. So what's the punchline to this whole story? After all the smoke cleared, after the tourists and weak hands were shaken out, silver still closed the month of January up 19%. The crash didn't kill the bull market, it just got rid of the speculators. Paper plunged, but physical vanished. So, was January 31st a crash, or was it the sale of the decade? Let me know your move in the comments below. Are you buying this dip, or are you waiting for more blood on the streets? Thanks for watching, and don't forget to subscribe for more deep dives.